welcome everybody. My name is Eric Rosen. I'm really excited to be here with three very good friends. Anytime I'm with these three, I feel smarter. I learn from them because they're so wise about markets and everything. And they're all contributors to the Rosen Report. And I ask them questions frequently. We have Alon Rosen, who's a managing director and head of institutional equity derivatives at Oppenheimer. Alicia Levine, head of investment strategy and head of equity advisory solutions at BNY Mellon. And then Peter Bachvar, who's a chief CIO of Bleakley Financial Group. And he also does a report as well, the Bach report, which is fantastic. So thanks for coming. So let's start with Alicia. You know, markets have really been more resilient than people thought. I sure didn't think we'd have another year like we've had, and especially what's happened in the last couple of days. Yesterday alone, we had a 1.6 trillion added to the equity market cap in the U.S., the fifth largest rally in U.S. history. You know, despite the fact that Goldman is calling for 3% returns for the next 10 years, annual returns for the next 10 years, you know, what do you say now that the election is behind us, markets taking out uncertainty? Where are we heading for 2025? What do you think?
Look, I think we still have a good year in 2025. It's a new administration, even though it's the second administration, it's still a new one, certainly very different from the one we have now. And typically new administrations tend to have very good first years. With that, the Fed's cutting into a soft landing, loosening credit somewhere in the economy, not everywhere. But typically when the Fed cuts into a soft landing, you get positive returns 12 months later of about 16 to 17%. So we had a 25% year last year, but we only returned to the old high in January of 2024. So we're up about 24% year to date. We still think you can move higher into next year. There are a lot of issues out there. There's fiscal issues that are going to have to be dealt with in Washington and very quickly because the tax law expires at the end of the year. But we think ultimately the setup is quite good and we think the economy is pretty strong here.
Okay, what about you, Peter?
I think at the S&P 500 index level, I think the key will be whether these big cap tech stocks can continue to carry a lot of the weight, or has that trade sort of splintered in sense of all those stocks not moving together. And all this AI spend, where each of these companies are spending $10 to $20 billion a quarter, are they going to see a return on this investment? Because if investors start to question that, the S&P 500, which is very concentrated in those names, may not do as well as possibly the rest of the market, which starting in July, the market started to broaden out. So I wouldn't be surprised if small mid-cap stocks and the other 493 S&P 500 stocks do better. But I think a key factor in all of this will be, where do long-term interest rates go? I say long-term interest rates because what we've seen is the Fed wants short-term interest rates to go down, but long-term interest rates are going higher. And the economy is very mixed in terms of who is very bothered by the rise in interest rates and who is less. If you're a small, medium-sized business, you're paying on average 10% interest rate on the loan that you're getting. If you're a bigger company that's termed out your debt, well, you're much more immune to this level of interest rates. And also, the multiple on the S&P at 24 times, I do think if you start to get above 4.5%, which I know is the sort of the threshold here with the poll, I think valuations may start to matter here.
Okay, great. So just a reminder, there's a chat out there. If you have a question for me that I'll ask to the panelists, please send it in the chat and we'll try to get to all the questions. Okay, so markets, this is a chart. It's not updated. It's up to 2019, but I put the returns for 2021, 22, 23, 24. You know, basically this shows that markets like a split Congress. So I don't know, Alicia, do you have a view on you know, with a split Congress, it looks like the Republicans are going to take both the Senate and the House. Does that make you alter your view of the stock market, or do you think that leads to underperformance versus a split Congress like the chart suggests for 70 years?
So look, we were kind of rooting for a split Congress because of this chart that you've shown. In particular, both the programs of, you know, the vice president and the former president tend to be very spend heavy and heavy fiscal spend here. So what we're going to get here is the House probably only has a 1 or 2 seat advantage for the Republicans. It's going to be hard to keep that entire committee together. But I think one thing that the Republicans are united on, because this is why they were put on earth, is to cut taxes. So I think you are definitely going to see an extension of the 2017 tax cuts. So that is going to create an issue on the deficit. And so the administration is going to have to find offsets somewhere, because they have said, if you listen to the candidates for Treasury Secretary, they're talking about finding offsets. So the offsets are either in the IRA, you're trying to pull back some of the hundreds of millions there, or finding other ways, or tariffs. So you might get some policies that are not exactly business friendly right up as Congress tries to find offsets for this $4 trillion over the next 10 years. We would have preferred a split Congress here as just a way to keep guardrails on it. But ultimately, we're not changing our view, because frankly, personnel is policy, and we're simply going to get a more business friendly view at the FTC, at the DOJ, at the regulatory agencies. And that's part of the reason you saw the market rally. I mean, forget Goldman, an average of 3% for the next 10 years. You got 3% yesterday. So, you know, that alone is worth several points of multiple, I think.
Alon, you have any comment on this and kind of what trades or what vol trades you're suggesting with this chart?
Yes, you know, just in general, just to track back a second, Alicia, great call back in August. You know, you were a big bull back then, and no one even thought 6,000 was going to be correct. And, you know, I think what we did well on the call last time was we recognized you have to be long stocks right now. Inflation's carrying every asset value, and there's no reason why that can't continue. But I think you have to be hedged. And in volatility, what happened was vols were so high into the election, you know, with the VIX at 22, 23, it was options and kind of protect yourself in a cheap manner. But now you know why. There was a vicious move on the up. We could have had it the other way. IWM, we always said small and mid caps were going to catch up. That's where you're seeing the dispersion. Small and mid caps, as Peter alluded to earlier. And that's what we're seeing happen right now. There's really no caps. There's a lot of catch up to big tech. As far as S&P is concerned, it is going to come down to NVIDIA in a few weeks with earnings. It's still trying to break out here, but that is going to lead the way. And the real action has been the cross asset players have been playing the AI power infrastructure plays, the CORZ, Wolf, a lot of these ex-Bitcoin miners that became now all about AI power. We're seeing that in utilities. We're seeing that also in nat gas names. So there's a lot of themes right now that have still been uncovered and have more upside. You know, nuclear got pretty bit up the last two months in that capacity, and it's getting a little crowded, but there's still going to be upside there. So there's a lot of opportunity in many themes and sectors, and that comes, you know, to materials and industrials. You know, those powered through. Yesterday, you saw a little follow through today, but you know, then all of a sudden, big cap tech is back. But at the end of the day, I think, you know, you stay long different themes and stocks and select hedges and just manage your nets around that.
Okay, thanks. So I've got like 10 questions that just came in. So it's so many. We're going to try and rip through them. I'm going to go to you, Peter. You know, could you comment on growth versus value right now, based on where we are, rates, election, Trump, growth versus value? What do you think?
I mean, the growth value discrepancy back in July, and I keep referencing that July point because July is when the market started to broaden. That differential, I think, was wider than it was in March 2000. So I think there's a tremendous amount of catch up for value stocks relative to growth, particularly, as I mentioned, if the big cap tech stocks with $3 trillion valuations, if investors continue to question their growth rates, their spend, and whether they're going to see a good enough return on all that spend, then value has a very good shot of outperforming growth.
Okay, great. I agree with that. Okay, we got so many questions. I can't let other panelists read. Just Alon, when you're speaking, make sure that that you have. It was breaking up a little bit when you're speaking.
Oh, got you.
Your
Thank you. Sorry about
your favorite long and short position, Alon. How would you express a long and short position on what, based on this the market conditions right now? Security, not asset class.
You know, I would say security-wise, someone mentioned nat gas, and we're pitching names like AR, EQT, EXE, and that theme right now. We do think can play catch up. We think the calls are cheap
through cash, like cash or long calls,
you know,
or what are you doing?
I think both. I think you can have a combination. We like to start off a position in cash. We like to buy upside calls in combination with the idea that if we do get that bounce, you can reduce your cash and then keep the calls to maintain that upside exposure in a defined risk manner. I mean, I'd gladly follow up.
Well, any short that you like? Any short you like?
You know, Unfortunately, everything seems like a short right now. It's hard to short big cap tech, but it also does seem to think, who are the incremental buyers at some point. So we're keeping a close eye on the cues. If you're running very long in that sector, we're seeing a lot of interested investors in selling 10% out of the money calls to fund close to the money put spreads for protection as we get closer to the end of the year, as these stocks continue to get
Okay.
bid up. So that, it's one area we're targeting.
Alicia, you generally don't give single stocks, but is there any single stock or bond play that you like, long or short?
So look, I think staples are challenged here in this kind of world because I think the transfer payments are just going to be less and would be under Paris. So I think transfer payments are tough. Staples really trade on like food stamps. Trump's going to get rid of, canceling student debt. So I think that sector is going to be the most challenged here. Also, we just think yields are higher, which means some of the utilities, and not the ones obviously related to power generation for AI, but to the extent that utilities are yield plays and did well for 6 weeks this summer, I think that those are going to continue to be challenged here.
Okay, so trying to get through all these questions. So this question is near and dear to my heart. It's basically, and I'm guilty of this, I've been calling for the end of the world, or at least a correction, for a while, and I've been proven wrong. I sold the consumer thinking that it was tired and weathered. We'll talk about that. But the question basically is, are we going to see a decent correction, or are we, going to go up 20% for the next couple of years? So, Peter, what say you?
I think the big question, and I said it earlier, is how the bond market behaves here. The bond market, and I'm not just talking about the U.S. Treasury market. I'm talking about the UK gilt market. I'm talking about the German Bund market today as their government coalition split apart. I'm talking about the French government bond market with worries about their budget. We're seeing an unwind of an epic sovereign bond bull market, and if rates continue to move higher for not good reason, and I say not good reason because there's a tendency of just analyzing long-term bonds and trying to guess where interest rates go, just looking at inflation and growth. But I do think that the flood of supply does matter now. And if you get the gilt market is the perfect example, where in response to the new chancellor of the Exchequer, Rachel Reeves, the market was pretty disappointed with her budget and gilt yields spiked. I would not say that can't happen in the U.S. Treasury market. So if the 10-year yield gets to 4.5, 1.75, we retest 5 from last year, I do think that there's a high potential of a correction. And even within the U.S. economy, we have a 2-lane U.S. economy. We have the fast lane and we have the slow lane. We have AI spend, we have government spending, we have the IRA, the CHIPS Act, high-end consumer spending in the fast lane, and we have low to middle income spending in the slow lane, along with manufacturing, existing home sales at 30-year lows, global trade. That's all in the slow lane. So the market corrections could happen within the market, and I don't see it as it's either going to be very good for everybody, very bad for everybody. It's a very mixed and uneven market and very mixed and uneven economy.
Alicia, you have a strong view. You think we're going to see a pullback? You think having out of the money puts on the market makes sense? Do you think that's going to happen or no?
Look, I would think we're due for something like that. We barely were corrected about 8% this year, maximum back in April or August. I mean, we and then lasted 3 days. So I think we're due for something here. I think when we first see what the priorities of the new administration are, that could be interesting. I think the tariffs on China will go on relatively quickly. Market's not going to love that. And at the same time, there's going to be an attempt to do budget reconciliation to get the tax bill passed by, let's call it June. So those two things together can be both inflationary and stimulative. So at some point, the market in this cycle has not liked yields over 4.5. Now we've almost got there yesterday, and the market seemed totally disconnected from the bond market. But I think anything over 4.5, that seems to be the place where the equity market starts getting worried about where we're going on this. So look, we're going to be spending a lot of money here. I'm not sure they can find all the offsets for what they want to do.
Yeah, there's no chance. We're running $2.2 trillion deficits in perpetuity. Okay, I've got so many questions and we're trying to get through our stuff. Who wants this? Do you think the deductibility of state taxes will return, or is that too blue? So the whole SALT thing, I had heard, I'll take it. Trump, both parties said that they were going to, return SALT deductibility. Trump said it and Harris said, at least that's my recollection. So I think that's probably coming back to a theater near you. Question from Christian: are the climate green stocks going to recover, and what would stop the bull market? So I guess let's talk about the climate green stocks. I don't know. Does anybody have any strong view on that?
So Trump has said he's going to take away the EV subsidies. He's going to take away the offshore wind. So it may be very narrow where he's going after, but I think these stocks are down for a reason.
Tesla didn't hear that. Tesla was up like 100% yesterday. So
that was about the removal of political risk.
Yeah.
Well, also Tesla, and I think this is any investor in this space, Tesla can make money even though they've gotten hundreds of millions of dollars of tax credits over the years. So they've been a big beneficiary of this. But a company has to be able to be profitable without these tax incentives because of the risk that they go away. If you can stress test the P&L of a company and they can make money without them, then you can invest. If they are solely dependent on these tax credits to make money, I'd be more worried.
Okay, question. Thoughts on M&A rebound recovery? I'm a believer that this part of the market reaction yesterday was lower regulation. Khan is going to be gone, and there's going to be a new sheriff in town that's going to lead to a lot more activity. You're probably going to start seeing more IPOs based on the level of stocks and what we saw yesterday, and a different regulatory picture. I'm of the opinion that we will see a lot more activity. Anybody has to take the other side of that? No.
Yeah, M&A
Okay.
bankers had a party Tuesday night.
Yeah. Same side, Eric, for sure. Big time.
Yeah. Okay. I love the fact that we're getting, more clarity here. A lot of questions. Do you think, so do that government? Okay. I'm going to take Sammy's question. We're going to get there in a minute. Okay. I've written a lot about the consumer and concerns about the consumer, whether it's credit card debt levels, 23% rates on it, card delinquencies, credit card delinquencies, auto delinquencies, even mortgage delinquencies are rising. The proliferation of buy now, pay later, it's something I am adamantly opposed to. I hate buy now, pay later. Where are we on the consumer, Peter? What do you think, where are we in the cycle of the consumer, and are you starting to see any concerns?
So it's clear that the lower to middle income consumer has definitely toned down their rate of spend. They're focused more on needs, not wants. I've heard many times the choiceful consumer. I heard it again in an earnings call just this week, that is seeking out value. And then you have the upper income consumer that is spending like, everything is fine on travel and leisure, going out for dinner. So I think it's a really bifurcated consumer. And the lower income consumer obviously dealing with the cumulative rise in inflation, the high cost of living, particularly if they're renting. But keep your eye on the upper income consumer, because I think they're also very sensitive and benefiting from the rise in the stock market as well. So if, Alicia's right, and I think that she probably is, that we do get a pullback at some point, the extent of that could also flow through to that upper income spending. So you can't just paint the consumer with one brush, because again, we have sort of like two consumers here, and depending on who you're catering to will really dictate the state of your business.
So if I can just, piggyback on that, overall consumer net worth is up $50 trillion since the beginning of 2020, right? And that represents about a 40% increase in consumer net worth. So CPI is up about 21% in that period. So if households have financial assets, to Peter's point, so real estate, stocks, bonds, pensions, 401ks, those households are feeling pretty good because they're outrunning inflation by about 2 times. It's the households without financial assets that have been exposed to the inflation. And it's more than 21% in 4 years for them, because they have rent, food, and gas. And that's about 40% since 2020. So you have this bifurcation, and any household that has to live on the short end of credit has really been feeling like they're in a recession, which is, I think, what we heard in the results of the election here. And so the data overall in the aggregate have been great, but 40% of the households are not great. And so the Fed had to start cutting because that bottom 40%, it was starting to leak into the rest of the economy. Both things are true at the same time. Households are wealthier, but only 60%.
Yeah, I know if you go trying to take a vacation or go out to dinner, all families try to take vacations over the winter break and the spring break. I wrote a piece about the absurdity of the cost of a vacation. When they told me how much a hotel was, I was like, am I staying in a gold and platinum, sheets or something? Like, what's going on? So it's very frustrating, but the low end consumer, these charts show that they're really starting to struggle. We are seeing more delinquencies across the board. Okay. Where are rates going? We touched on a little bit. We saw another rate cut. There's about 20 basis points priced into the market for the rest of the year and another 75 for next year. I'm going to pose the question, has the Fed lost control of the bond market? Fed funds have cut 75 basis points. I believe the 10 years up about 70 basis points since they cut, and the 2 years up about 55 basis points since they cut in September 18th. So, Alon, do you want to talk about this, or do you want me to?
Yeah.
Okay.
It's one of those situations where you're really seeing the divergence with their stock and equities and asset classes are just ignoring the hindrance of rising rates. And Alicia and Peter said it well. Can we, from even a seasonal perspective, keep rising into Trump's inauguration, and then kind of like 2022 type of pattern where all of a sudden, we can not fall off a cliff, but start to get tax loss selling in the new year. Everyone wants to delay. There's a lot of gains in the market. There's a lot of factors that could keep this market afloat, and then kind of realize, okay, bond yields are not going lower. They might not cut next year. They might be forced to. Trump wants mortgage rates lower. And that's why people think that he made that comment about keeping Powell until 2026 earlier. But there's a huge disconnect here, and something's going to have to give at some point.
Alicia, you have any comments on that?
Look, in the end, the Fed doesn't control the long end. It only controls the short end. And, the message from the bond market is sort of all of the above. It's better than expected growth. It's slightly hotter than inflation. It's, the Trump's odds rising in winning the election. And it's, so it's those three things that have caused this problem on the long end. I personally think that we stay higher for longer on the long end because we just think growth is better, and there's going to be so much supply here in order to fund the government. This is not going to be an austerity plan, and I know that Elon Musk has talked about getting rid of $2 trillion. The budget's $6 trillion. You can't get rid of $2 trillion. It'll be a major recession.
I think you could get rid of a lot, but I'm with you. Okay, Peter, we're going to tackle this one. There was a question before about government debt and tariffs. So when will deficits matter? We're at 36 trillion. The CBO is projecting $22 trillion of deficits over the next 10 years. It will take us to about $60 trillion of cumulative debt. You can see how much we've expanded over the last 15 years with the global financial crisis, with the pandemic, and now just runaway spending. So one, how does Trump impact this issue? And two, when will deficits matter?
So it was the mid 1980s when people started to complain about U.S. debts and deficits. And here we are 40 years later, trying to sort of answer that same question of when it matters. And I do think it matters. And I think I look at the price of gold at give or take around record highs as one sort of signal that it matters. I think that the foreign purchases of U.S. treasuries, which their ownership stake is about 30%, it was 50% 10 years ago. They want less of our assets. So at least in their eyes, U.S. debts and deficits matter. So I do think we're sort of testing the boundaries of it really mattering. And I don't know if it's that gold signal, or maybe that lift in long rates, or maybe at some point it's going to be a break in the dollar that all come together to sort of give that signal. But I think we're sort of getting into that dangerous territory where it does. And where I know it does, because we just have seen evidence of it this past week, is in the UK gilt market, with the spike in gilt yields in response to the release of their budget. So at least there, those debts and deficits matter. I mentioned earlier, we've seen an uptick in French yields as they are trying to put together a budget. So I do think we've reached the point where it is beginning to matter. And I think that's now the dangerous game that the U.S. government's playing. Now, the question of when will it matter in terms of triggering a response in Washington, D.C., unfortunately, they'll never get ahead of the game. They will only respond to a crisis, And I define crisis as an uncontrollable rise in the 10-year yield to 6%. The 10-year yield goes to 6%, you will see, committees and hearings in Congress saying, okay, we now need to do something. Now, I'm not saying we get there, but I'm saying that unfortunately is going to be the trigger to bring that conversation front and center.
So my view is, if the 2024 election was about the border and inflation, are you better off? I think the 2028 election is going to be about deficits, debt, and entitlements, because you have a bunch of stuff happening right around that election where Social Security is going to be an automatic cut around 2030 because they're running out of money. And I think they're going to be front and center. I'm hopeful that Musk can go in and cut. I think $2 trillion is unrealistic, but there's so much government waste. I'd like to see the end of the omnibus bill, which a lot of crap goes in there. I'd like to see a change in entitlements. I'd like to see age. We have not changed the age of Social Security since 1935. Average age of lifespan was 60.7. Today it's 78. We're still giving Social Security at 65. Stanford came out with a study a few weeks ago that over 50% of kindergartners today will live past 90. Our system wasn't built to give Social Security and Medicare, Medicaid for 40 years. So that, and I'd like to see means testing, and I'd like to see a raise of the cap from 150 higher in terms of when you contribute to Social Security. Okay, a question from the audience. FJ Labs is a really impressive fund that I interviewed Fabrice Grinda. I think he had 39% returns for 25 years. He's made 1,300 individual venture investments. He's a very, very impressive man, an investor. The question is, for all those who invested in FJ Labs, it seems the new environment should increase the likelihood of strong results due to less technical regulation, more overall froth. Maybe interest rates are the wild card. I agree. We talked about it. You're going to see more M&A activity. You're going to see more IPOs. The market's going to open up. Lena Khan's gone. So I think that's a no-brainer. And I've talked to a lot of crypto guys, a lot of venture guys in the last 48 hours. They've reached out to me. Private equity, they're all ecstatic. As I think Alon or Peter mentioned, that there's champagne bottles popping Tuesday night when it was announced that Trump won. There has been such a top on IPOs and M&A activity for all the wrong reasons. And I think that just came off. So I think it's going to be very good news. And I'm actually allocating more dollars to things like FJ Labs, tech, and private equity funds.
Yeah.
Okay, more questions.
Eric,
any comments?
Just to follow up with
Go
you,
ahead.
Eric, I got a call today because I'm in some crypto from the ground floor, and probably went to 0 5 different times. He just told me it's maybe like 25, 50 times now. He doesn't even know there's stuff going on, but there's a lot of ecstaticness going on in that world.
Yeah, I talked to a crypto venture and a crypto hedge fund manager today, and he said, I've done this a long time, made a lot of money. I have never been more excited about the crypto market and what the possibilities are under this administration than I have been in my life. There's a Bitcoin chart, so that's very good.
Feeling
Okay.
underinvested in Bitcoin.
Yeah. So I made the mistake. I bought some altcoins early on, and they all got torched. But hopefully, there's some oxygen in the air, and they come back to life. Okay. Assuming House stays Republican, if tax reductions don't sunset but get extended at the end of 25, what will the impact on markets be? Peter, why don't you tackle that one?
Well, that's the important question, because in 2016, when Trump became president, there was a lot of low-hanging tax fruit that he was able to pull. He was able to cut the corporate tax rate from 35 to 21. I think that's staying the same. So at best, it stays the same. With respect to the individual side, at best, it stays the same. So we're not going to get that incremental tax cut drive to the economy. So I don't necessarily see what the stock market and economic stimulus is to it if tax rates just stay the same.
Except we did avoid a fiscal cliff, right? So we're avoiding a tax increase for much of the population here that pays taxes. That's the one thing.
We're avoiding a negative, exactly.
We're avoiding a negative. We're avoiding the fiscal cliff.
Yeah, I'm worried. I mean, Trump was on Rogan, talked about eliminating the income tax. I mean, we have such fiscal issues that I get nervous some of the crap that comes out of his mouth. But I am very cautious about lowering taxes anymore until we can really cut the deficits a little bit. I like to think of it more of a spending issue, but I don't want to see any revenues go away. So,
well, just to put some numbers around that, Eric, over 100 years, or at least post World War II, tax revenues as a percent of GDP has averaged around 17% when taxes were high, when taxes were low. Spending, so right now we're around that level. Spending, unfortunately, is averaging 23%. Well, is right now at 23% of GDP, where it's typically 19 to 20. So it is a spending problem, not
Agreed.
a tax problem that we have.
Yeah, I just don't want to see him. I don't want to see tax revenues go down. I'm very focused on budget deficits and getting it under control, and I don't want to see it. The CBO is always low. They've never guessed right, and they just upped it to 22 trillion over the next 10 years. So that means I'll take the over. Okay. Alon, why don't we ask you this question? Paul Tudor Jones was on CNBC the other day talking about how much he loves commodities. And so do you have a great way to express a view on that using options or ETF? What do you like?
It's actually named DBC. It's a commodities ETF. It has not moved because commodities have been, pretty mixed within this market. But it's ticker DBC. It's an ETF. I actually just scooped some a couple of weeks ago, and it's one of those where the premium's cheap. But if you do get a magnitude move, you can make a decent amount of money in longer term options here. I would buy duration in this one.
Sure, buying 6-month calls.
At least I think, we pay a little because once it moves, you want to have that exposure and you don't want to time it. We're not sure if it's going to move this month, next month, but when PTJ speak, he normally is right. You look at Tepper, it took him a while to get China going, and now China all of a sudden went from dead to, being alive, and things that are hated, and positioning is so low with sentiment so low, you typically want to get involved in some manner. So I think there's something to do there. DBC is the easy call. Energy's mixed.
Alicia, what about you? Any way you like to play commodities from the long or the short side?
Look, I mean, I think gold is still fine here. I think copper is still fine here. And because of the energy needs, ultimately commodity, you really have to have a view on global growth in order to do this. So, if you're positive, I would just buy the basket.
Yeah, we're very bullish on commodities.
And so, being very bullish on commodities, I want to give actionable steps for the audience. Being bullish on commodities, does that mean buy calls? Does that mean buy wheat, buy copper? What commodities do you like specifically?
We're long energy stocks, particularly you guys mentioned natural gas. I think that $70 oil is a buy, and the energy stocks are a buy. Agriculture along the fertilizer stocks like Nutrien and Mosaic. Been on the nuclear trade for a while and remain so, and Cameco and some others. And precious metals, as Alicia said, very bullish, particularly on the miners.
Great. So we have actionable items, which is good. I'm going to pause for 1 second. I think I got all the questions. If Gretchen and Maisie, if I missed one, can you just throw it back up on the chat so I can see it, because there's so many of them. I missed one. And if anybody has questions, we're going through this stuff quickly, so we can definitely take more audience questions as well. So we kind of tackled the gold thing. Let's go to Bitcoin. I mean, we touched on it a little bit. We touched on crypto being good.
I have a question when you're done.
Go ahead. You go.
My question was a tax question related to whether you think the state deductibility may come back, or is that too blue?
Well, no, I talked about it. I do think that both Trump and Harris both said that they are going to return the SALT deductibility, and I think that's going to happen pretty quickly. Trump said it 5 or 6 times himself, and Harris said it too. So I'd be shocked if that doesn't come back very quickly. I don't know that that's enough to stem the migration. I moved to Florida 7 years ago from New York City, and I can tell you that the migration continues, albeit at a slower pace than 2021 and 2022. But try finding a high-end house in Miami or Palm Beach. There's nothing on the high end on the market for very long. If it's priced anywhere near fair, it trades in a hurry. And I'm talking at 40, 50, 60, 70, $80 million. David Beckham just bought a house 3 weeks ago I wrote about for $73 million, and there were like 12 bids on it. I mean, I didn't know that many people had that much money that could buy a $70 million house, but apparently on North Bay Road, which is the nicest road in Miami Beach, there's very little in the way of new inventory. So I do think SALT deductibility is coming back. Okay, Bitcoin.
Personally, I would short that market and buy Canada. But that's my own.
Yeah, but maybe buy Canada, but you sure as hell don't want to live there. My whole family's from Canada. I would never live there. But I think I'll bifurcate that, because I invest in a lot of Florida real estate, and I'm a I'm a broker. I would say the high-end market has such little inventory, and as long as the policies of New York, Illinois, California, Minnesota, New Jersey, and Connecticut, blue states continue, I get calls every week from wealthy people who are trying to relocate to Florida, and I don't think that's going to stop. What I would say, to be more nuanced to your question, Florida has not seen more property for sale in a long time. I think there's, the amount of houses in Florida are way higher than 2019. The cost of insurance, the cost of maintenance, and now the cost of taxes, because since I've been here, housing prices are up 300 to 400% in 7 years. And so your entry cost is so much higher. A lot of people can't afford it. And the old condos, those things after the collapse in Surfside, all these condos have new regulations, and they're getting crushed with new assessments. That market is getting killed. The low-end market is under pressure. I was told, I'm insured by Chubb. If I sell my house, I cannot get new coverage. Chubb will not write a new policy in Florida. So when you go and buy a big house, you can't really get coverage and good coverage insurance. It's very hard and very expensive. But as long as the migration continues and they give you bad service in New York City and Chicago and LA and San Francisco, wealth is still going to come this way, and it's coming. Okay, Bitcoin. We talked about it for a second. All-time high this week. I'm in one of my trades. I own Bitcoin through a wallet. I own it through the Grayscale Bitcoin Trust. Now that those changes have taken away that massive discount, is there a way that people like to play it? Are you doing options in that alone, or do you trade Bitcoin options or no?
Yes. So they're a little complicated because it's under BITO, BITO, and there's a monthly dividend which isn't consistent. And I'll send you how it's calculated monthly, but you can play it near term, ideally, maybe 1 month out maximum.
Okay.
Very active, BITO.
Alicia, do you how do you like to play it, whether crypto in general, or what are you guys telling your clients?
Well, look, we tend to be very conservative on these things. So, the chart looks great. We think there's clear sky up there, but we would just do the ETF.
Okay. And Peter?
Well, for the desire of a finite asset that can't be printed and so on, we prefer gold and silver, but I do respect Bitcoin, and I follow it pretty closely.
Okay. Sorry. Okay. Yeah. It's a question about the ETF. It was DBC that Alone spoke about. DBC. Okay. Hold on. Somebody's asking another
Apologies
question.
to everybody. I'm got caught en route. If anybody's near the grill, drinks on me between 5:30 and 6:30.
Damn, you're lucky I'm not there. I'd have taken you deep. Okay.
Maybe caviar if you were there, Eric.
Yeah, I would have gotten lobster caviar. What are you talking about? It's on you. Can the speakers elaborate on the positioning and view of small, mid-cap, and large-cap stocks? Alicia, why don't you tackle that? We did see a 5.5% move yesterday on Russell, so that's pretty telling.
That's pretty telling. Look, in a market like this, with the Fed cutting and no recession and pretty benign conditions, mid-cap should outperform both the large cap and the small cap. Now, small cap, if rates stay high, right, if you still have the yield problem on the long end, then those small caps are funding themselves with floating rate debt that's coming due within the next 18 months or so. So I wouldn't buy the index, but the move was so extraordinary yesterday. Like, you took out all that resistance above it. And so it's workable, it's playable, but I think you have to be careful there because you may have fundamental issues on the debt side for the small caps. So if you're sick of large cap and you're sick of FANG and you're sick, small cap actually, historically, in markets like this, when the Fed is cutting into a soft landing, outperform everything.
Okay, great. Peter, you want to tackle that at all?
So when it comes to buying stocks, I am market cap agnostic, but I am finding much more attractive names in the small mid cap sector. I think you had to be very careful, as Alicia pointed out, on balance sheet. And I think the only way to really invest in small and even mid is not necessarily from an index standpoint, but to really dig and find the quality companies that have been sort of left for dead in this chase for
Can you give us a couple of examples? You have a couple examples of things left for dead that you think are super cheap in here in the Russell?
Well, one of my favorite names that has just gotten absolutely destroyed is Estee Lauder, left for dead, a stock that's gone from $375 to $65.
Okay, there we go. More ideas. Okay,
More
questions.
That was a mid to large that all of a sudden became small.
Right.
Okay, Question. Oh, geez. Just view on estate and gift tax exemption. I'll tackle it really quick. There was concern that $13 million person exemption was going to go away and be lowered to 4 or 5 million. I don't think that happens. Trump's friends with all the rich people. I don't think it's going to go up, but I don't think you're going to lose that big exemption. But there was a lot of nervous people. I talked to my tax attorney, and he said there were people very nervous, ready to go if the Democrats won, because that was something that they wanted to tackle. Okay, does the Trump administration create a change in your portfolio allocation? If yes, which? Alone, what do you think? Because Trump won, do you change anything? Do you put a different trade on?
I think the obvious plays ended up playing out. The jail plays, small and mid caps. I think we keep touching on the same factor here, but I think you could ride those because they've been in the gutter for so long, and recession isn't even a word that people are talking about right now. And whenever the recession happens, it's going to happen because no one's ever predicted it. And that's another conversation for private credit, of course. But I think right now you stick with the small mid cap theme. Growth could get tapered because of the bonds at some point. If it keeps rising, that should hamper valuations, one would think. But in the meantime, the money flows are so strong, it's hard to get in front of them.
Alicia, did you change anything? Did you recommend to change any portfolios because of the Trump trade?
So we would add more value. We think financials look great here. When the yield curve steepens the way it did, it's great for financials because lending is profitable again. So that's great. We go down the cap scale here, as we've discussed, for the reason that they just simply haven't performed the same way as the S&P in the last few years. There's a lot of catch up. I don't like the index level of the Russell. It kind of scares me a little bit. There's a lot of, what's good about the Russell, it's got financials, but it also has healthcare as one of the largest sectors. And healthcare is sort of just dead right now because it's really a recession play for the most part. And so it's a difficult area. Choose your stocks here. I'd say the other thing is, with the strong dollar, we're really very underweight rest of world and always have been, because the deepest capital markets are in the US and we play the long game. This only, what happened with the election on Tuesday really only solidifies this for us, because if there are tariffs and there's a strong dollar, capital comes home, reshoring of supply chains, it's the US and it's small and mid cap stocks as well, and value.
Okay. Peter, do you want to say anything there?
Well, actually, I'm pretty bulled up on outside the U.S. To me, looking out from a longer term perspective, 10 years, the growing middle class in Asia, to me, is the most exciting growth story in the world. You're talking about half the world's population, and it's India, it's even China, whose middle class is going to double over the next 10 years. It's Indonesia, it's Vietnam, it's Thailand. Companies that can tap into that consumer, I think, have very attractive stock characteristics. We're long stocks in Macau. We're long AIA Group, which is one of the largest life insurance companies in that region. So I am very excited, actually, about that area of the world outside of the U.S.
Okay, another question from the audience. Most of us on the call made a lot of money the last 2 days. The bottom 50% of the country have the same net worth. It's about income inequality, which we've kind of touched on a little bit. But the question is more specifically income inequality under Trump and potential long-term threats to our collective prosperity, democracy, and humanity from the continued growth in income inequality. It's something I'm very concerned about. The haves and have-nots, and the charts that I showed you where, a big chunk of the population is struggling to make ends meet and to keep up with inflation. And you go to the grocery store and buy food, and their car payments, house payments, credit card bills. And then the other half, or the other big chunk, have a lot of money and is not really worried about it. I think it's only going to get worse. I don't know if you have any specific policies, Peter, that you think Trump is going to enact that's going to make it better. I'm not that granular on it. What do you think?
Well, I think it's important to distinguish between income inequality and wealth inequality. And Alicia touched upon it earlier about the wealth inequality, those that own stocks, those that own their home. In terms of income inequality, one of the positives over the last couple of years is wage growth has trended about twice the pace that we saw pre-COVID. So while we did see call it a 20-25% rise in inflation, average hourly earnings has actually risen a similar amount. So while there's certainly a part of the population that's very stretched, we've actually seen some very good wage growth, and hopefully that continues. So I'm more worried about the wealth inequality, but I can also blame the Fed for that wealth inequality because, QE was basically monetary policy for rich people. And we had many, many years of QE, and home prices up 50% in 3 years because the Fed was buying mortgage-backed securities. So I think the Fed is a culprit in the wealth inequality, but luckily on the income inequality, I think we've done a pretty good job the last couple of years.
Yeah, I mean, I will just take the other. I mean, I agree with everything you said. I would just say inflation up 22%. I'll take the over on that because everything I do, there's nothing that's up 22% in 3 years. You go stick of butter, eggs, go to the store, go on a plane, go to a vacation, go out to dinner. Everything's up a lot more than that. But I hear that the stated number, it looks like good. I don't think that the wages have kept up as well with inflation as the stated numbers because everything I buy is up more than 22%.
I agree with you.
Only in the last 2 years. It doesn't
Yeah.
overall, real wage growth is up 15% in the aggregate. CPI is up 21, 22%. As we spoke about, those without financial assets, their inflation rate is closer to 40% because it's those three things. It's housing, it's rent, and it's food. And those are all up much more than 20%.
Okay, let's talk about the dollar. And, guys, keep the questions coming. So the US dollar, we've seen a spike. Can you pull up that chart for us, the dollar chart? Yeah. So this is the DXY chart. We've seen a healthy spike here over the last few weeks. Alicia, why don't you tackle your view? I know you said you like the dollar. You're doing a lot of stuff in the United States, and especially if you think rates are going to be high for a while. I assume that you think that the dollar is going to be king dollar.
I think we're in a strong dollar regime here. Can you have bad days? Yes, you can have bad days, but ultimately, the global growth is just not as good. Between the tariffs and the reshoring, you're going to wind up with a stronger dollar. And, again, that does favor down cap companies, mid and small cap companies also, because 40% of the S&P revenue is coming from overseas. We think companies with exposure to China, like the Starbucks of the world, and maybe this is Estee Lauder as well, and the Nikes, you have to pay attention to that because there's going to be an issue with China. We think Trump's putting tariffs on pretty quickly within the first three to 4 months.
Alone, do you have any comment on the dollar? I know that's not really your main thing.
I think just back to the M&A and the strength of the economy and the markets. You look at sectors like biotech, even there's a lot of opportunity there. And I do a twice a month call with the analysts at Oppenheimer, and I'm coming out with 3-5 ideas. There's going to be takeouts. Several names already, feel ripe. Obviously, there's a lot of focus on the GLP-1 drugs, so we're focused on that. And I'm at the point where people think that could cure addictions, and there's a lot of competitors, and there's a big market for it. So I think there's a lot of opportunity in healthcare and biotech, to that matter. We didn't really touch on that, and that can help with the M&A. But as far as the strong dollar, 100% in agreement. As the rates rise, it's going to continue to shore up money here. And we made a call on our desk for the last month that yields hit their low, and we were shorting TLT, up around 100. It's come back a little from here, but we do think that's a sale on strength and just another way to play yields in the equity ETF market.
Okay, Peter, anything on the dollar before we move on?
Well, theoretically, tariffs are positive for your current currency because if you're putting on tariffs to reduce your trade deficit, reducing a trade deficit is currency friendly. So that, I think, is one reason why the dollar has recently rallied. On the other hand, the big question is, will Trump wake up one day and say, I need a weak dollar. I need to help U.S. exporters, and come out and say something like that. I'm not sure. We'll see who's Treasury Secretary, but I think that is one of the potential internal conflicts that we're going to see with the dollar.
Okay, got a lot more questions. Comment is on real estate. What sectors of real estate do you think are most interesting? And any comment on commercial real estate prospects over the next couple of years? Peter, why don't you tackle that one first?
Shopping centers. I think multifamily, which is if you're a Sunbelt multifamily operator right now, your rent growth is basically flat to slightly down because of all the supply. But we're seeing a very sharp decline in new construction. So by the back half of 25 into 2026, Sunbelt rents are going to go back up. Multifamily on the coasts, rents continue to grow. That's where there's less supply, and I like that as well. And I always think that Simon Property is interesting because there's no more construction of new malls, and they own a lot of the high quality ones.
Alicia, any comment on real estate ideas?
Look, I would agree with Peter. I mean, just to talk about Office Tower for a second, I can tell you, being in Midtown Manhattan, It's a lot more crowded out there, but it's not the same. And I think the sector continues to be challenged. And you know, as these leases come up, companies are going to take smaller footprints. So I think that sector is still exposed.
I mean, we have started to see a little bit more conversions, office to condo. We saw a couple more downtown and Wall Street area. You know, I think they're challenged very hard given the shape and the and the windows and the lack of windows. The windows is a big problem. The elevator is a big problem. But I wish there was more of it. Okay, this is a great question from iPhone 520. I don't know who that is. What's the biggest surprise for 2025 not priced into the market alone? What's the biggest surprise and how are you going to play it through the vol market?
You know, I think we have to talk about the rates. You know, are people really talking about 6% rates? Peter mentioned it earlier. That would be a shocker in the sense that it could have a lot more ramifications that people aren't pricing in right now. So we think volatility got very cheap very quickly. Can it stay down here for a couple months? Maybe, but we're going to look for ways to structure long volatility maybe over the next 3 to 6 months in different matters.
All right, Alicia, what about you? What's a surprise?
I think tech still continues to do well because Trump winds up being very good for large cap tech, which is not expected. Because he's gonna put up a fight with China.
Okay, Peter, what about you?
Well, considering how bullish sentiment is, I'm going to pinpoint one particular thing. In the Conference Board Consumer Confidence number last week, since 1987, they've been asking respondents, do you think the stock market's going to be higher or lower over the next 12 months? In the October survey, the highest percentage of people since 1987, when the question was first answered, said the stock market's going to go up. So just taking the opposite of that, a big surprise would be if the stock market actually goes down.
Yeah, well, you know, there's with vol crashed pretty hard the last couple of days, so there's easier places to play. So we only have a few more minutes, and I know I'm not going to be able to get to every question because we tried to tackle about 25 viewer questions, and we want to finish on something, but I'm going to try to get to one more. We touched on China. There was a question about bullish or bearish China. I know, Peter, you said you're very bullish. Alon said he's bullish. Alicia is less so. Is that fair?
Fair.
Less so.
Yeah.
Fair. Okay, so just trying to get through quickly. Outside of public markets and crypto, what asset classes in the alt space do panelists like? PE, credit, venture. Let me just tackle one. I get a lot of questions. I was 33 years in the credit markets and ran a credit fund. I think my PA, I'm doing 70% of my PA is done in hard money lending that I source myself. I'm getting 15% kind of returns on senior secured opportunities that I think are very interesting. I would just say this. We haven't seen a cycle, and a lot of these credit managers, these private credit guys are new. I would make sure that if you're allocating in the private credit space, you're allocating with people who have seen a cycle, they have restructuring expertise, because there is no liquidity in this market. And if they make a bad call, they're going to have to get through there's no way to sell this stuff. And so I do like private credit, and I think it offers pretty interesting returns. I think it's getting a little crowded, but if you pick the right manager with restructuring experience, I think it makes sense. Okay, Peter, what about you? What alternative asset classes do you like?
Well, I want to differentiate with private credit because I much prefer direct lending within private credit. I have no interest in private credit that is just buying other people's private equity LBOs. When I'm seeing a rise in payment in kind, companies in a growing economy with a 4% unemployment rate that are going to payment in kind, and a lot of private credit is going to these private equity deals. I have no interest in that because in a down cycle, I think they're very much at risk. Whereas sounds like what you're doing more direct lending with collateral. That's where I'd much rather be.
Okay.
Yeah.
All right. Alone, anything?
And I
Anything else?
agree 100% with Peter in the sense that, private credit is sexy. It's taken up all the money from a lot of different funds, especially some of my risk arb clients, because that 12%, guarantee is something that nobody can match without the volatility right now, especially if you're trying to be hedged. So, but I think direct lending, having the proper collateral, because we don't know if the recession is going to happen at some point, and there will be zero liquidity, and people will be stuck, and no one's felt that yet.
All right, Alicia, we're going to end on this. Everybody gets 1 minute to answer this question. What's the biggest takeaway? If you could put one trade on, long, short, asset class, single name stock, whatever it is, Alicia, what's your one idea that you'd like to leave everybody with?
And how long am I holding it for? A year?
A year to 18 months. I made that up. I don't know.
Like, I would just buy whatever great mid-cap companies you have in the tech sector related to AI, related to energy generation, related to the grid. I would buy that, close my eyes, and I'd buy it hand over fist, and I wouldn't get shaken out from it.
Okay, Peter, what about you? Other than Estee Lauder, limit it long on Estee Lauder.
Silver.
Silver.
Long silver and pair it against short 10-year treasuries.
Wow, gold. Okay, I like it. All right, Alon, what about you?
Like that silver call, Peter, I was going to mention that as an index and as single stock. I hate to say this, Eric, but I'm going back to EchoStar Sats. They restructured it. It's not going bankrupt. Charlie Argan, he played his poker. He lost. And there's upside there. We think the downside's over at least.
You haven't learned your lesson in that space?
I had a very nice conversation with a very smart guy in the name who explained to me what's going on now. It's a new company.
Okay. All right, great. So one question, have any examples of mid-cap energy AI firms, Alicia, getting more specific?
I'll get my analyst and I'll send it to you.
Okay, great. So we'll have them send around. So first of all, I want to thank my panelists. They're very smart, make me look good. I love it. I'm sad that I'm not with Alon today, taking him for getting free caviar, lobster, and very expensive
anybody
wine.
else will be in the corner.
So Alon is going to be there. Take him deep for me because I'm not there. So order good stuff and make him pay. Alicia, it's always a pleasure to see you. Thank you, Peter. Fountain of knowledge to all of you. Thank you. And thanks to 3i for putting it on. I always end with my Rosen Report hat. So we always have to represent the Rosen Report. So give us, there's a rate on this call. And thanks for all the questions and the active participation from the audience. Thank you very much. Appreciate it.